Well, the government's not good at not spending money, so the other lever they pull, like you said, is increase revenue. And this is a real easy one that could always be looked at.
All thoughts and opinions shared in this recording belong to the participants. Views expressed are as of the recording date, are subject to change, and are not guarantees of future results. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt here with Isaac.
Morning.
And Eli.
As always, happy to be here.
All right. We were waiting for it. Yeah, you haven't been on in a while.
No.
It's good to have you back.
It's great to be here.
The listeners have just been chomping at the bit, so we're thankful to have you back. Anything before we get started? You got some charts, a handful of charts we're going to get into.
Yeah.
And then a topic Eli brought.
Each one of these charts, depending on which one we're talking about, probably applies to almost everyone that's listening to this podcast.
Yeah.
So it's actually I think it's a really helpful one for people to watch all the way through.
Yeah. So we'll get this first one out because it's kind of the most depressing. Talking about the U.S. debt, right? But this is...
It's a hot topic.
Yeah, this is trying to... Yeah, it is a hot topic,
Yeah.
right? You've got Besson out there talking about buybacks, trying to manage, there's a lot, and just trying to manage. We've got ourselves into a not ideal spot.
Sure.
Right? So managing a lot of debt with higher rates higher than they've have been for a long time. But I thought this chart, I came across this, and I thought this was just a helpful visual, kind of zooming out. So this goes back to 1947. So this chart shows federal interest payments as a share of federal spending, total federal spending, rather than a dollar amount owed. So if you look at this today, 16.1% of total federal spending is interest payments. That alone is depressing, right?
Yeah.
Like you would hope it would not be that. Your personal financial situation, if you're spending 16% of your income on interest only, would not be, ideal. Not that you couldn't make it, but it wouldn't be ideal. But when you zoom out and look at since 1947, because you hear of all the doom and gloom, national debt's at the highest it's ever been. We're in a horrible situation, blah, blah, blah. And you zoom out, you're like, well, relative to the last 60 years, it's not all that different when you look at just how much we're spending on interest.
Well, that's always been kind of the rebuttal from any time I read into this is one argument is, hey, we need to spend less, and the other is we're always just going to pay the interest.
Yeah.
You always hear people, it's just
it's kind of
I listened to a guy on a podcast who literally was like, I never look at the national debt because we always just figure out a way to pay it.
Modern monetary theory or something? People that follow that, it's kind of like our debt doesn't really matter.
Yes.
Yeah.
Mm-hmm. And so, it kind of is right in line. That's what I see with this. It's it is right around where it's supposed to be.
Keep borrowing.
Keep borrowing.
I don't know if I take that approach. If you're talking about things that are my primary concerns, the national debt on a long-term basis is really one of my primary concerns. I actually kind of think that this is somewhat of like a chart crime. I think sometimes you can make charts look the way that you want them to look so that you feel better about yourself. And this, to me, feels like one of those charts. Because it's saying it's in line with our normal spending. It's saying it has always been 15% of our spending. But our spending as a percentage of our GDP is wildly out of line.
It's not saying 15 is healthy. It's saying that's the average.
It's saying that is the average spending relative to all of our spending, which is true. It's right there at average. But our spending relative to our size of country, our GDP, has risen pretty drastically here in the last 15, 20 years. So yes, it is average, but our spending relative to our GDP is getting really out of line.
Sure. Well, okay. Eli just burst my bubble. I was trying to make a positive spin on this. No, we
got to have some contradiction here.
Yeah, we definitely have an issue when it comes to the federal debt. This is an interesting way kind of looking at it if you're trying to make a positive spin. But I think this is about as close as you can get to making a positive spin.
Yeah, I almost felt good for a second.
Okay, we're going to move on because that was the worst chart that we're going to cover. All right, small cap. So I was joking with Eli and Isaac earlier. I've been waiting my entire career for small caps to do something. Mm-hmm. And we've had a few little blips here and there, but they've been very short-lived. Small caps had a strong first half of 2026. We talked about this a few weeks ago as well, but small caps have trailed large caps in 14 of the past 21 first halves, including steep underperformance in 2020, underperforming by 10%, in 2024, underperforming by 13.5%. But 2026 broke the pattern decisively with small caps outperforming large caps by 12.3%. So you can see here, this chart, small caps have not really done all that well relative to large caps in the last, 10, 15 years for sure. So this is one of the bigger periods that we've had. The small caps have rallied.
So I'm from Oklahoma, and because I'm from Oklahoma, I'm an Oklahoma City Thunder fan. And Oklahoma City Thunder, when I was growing up, there was a player that I absolutely loved named Russell Westbrook. Russell Westbrook was a dominant point guard, but he was cut from his high school basketball team because he was slow and unathletic. And if you know anything about Russell Westbrook, he was crazy fast and extremely explosive. And I think that is the story that I'm currently watching with small caps, where they have been cut from their high school basketball team, seems like year after year, and now they are athletic and explosive right now. And it's been a story, if you go back to podcast, where we have kind of just like preached diversification, and we've done it almost like we walked out to a cliff and have been yelling at the cliff, like, it will work, it's going to work. And what we're seeing now is that small caps have rallied to an extent where it's actually made meaningful difference within portfolios, even with small allocations to small cap. And that's been really fun to see, because we have been trying to preach diversification with small caps or international stocks, and now we're seeing some of the benefit from that.
Hey, that was a good story pull.
Yeah,
that was impressive.
Yeah, I mean, it's been years of if you work with an advisor, someone manages your portfolio based on like hey, this is why we own international. Hey, this is why we own small. Because
2023 was a horrible year for it. 2024 was a bad year for it. Like, if you were diversified, you were underperforming.
But if you zoom out, small caps have outperformed historically large caps over the very, very long term, right? It's just been the last 10 to 20 years they haven't. And so people started asking them, understandably so, asking themselves, like, well, why do we even have this?
Is there value?
Yeah. And so it's kind of it's refreshing to see, hey, international has added value. Small caps have added value. This is why you diversify. This is how you manage risk, right? By having different exposures to different parts of the market, different markets around the world. Thoughts?
Love everything you said.
Okay. So small caps, let's go. Hopefully they can stay.
It seems like every summer there's a small cap episode, and they're finally back.
Are you okay?
Are you pulling it? Small cap
summer. Come on.
Let's see if we can keep this momentum through the end of the year.
That's what I'm ready to see.
Yeah,
I want to see the rest of the year.
Small cap winter.
All right, hard pivot.
Sounds worse.
Federal estate tax exemption. I thought this chart was really just insightful visual, looking at the increase. 2017 feels like a lifetime ago, but we saw a dramatic increase in the federal estate tax exemption.
Can we briefly explain?
Yeah, I mean, you're going to know more about this than any of us.
So the federal estate tax is basically, if you have more money than they allow you to have upon passing, then every dollar that's above the exemption is taxed at 40% when passed to your beneficiaries. And so if the estate tax exemption was $10 million and you have $12 million of net worth that's being passed to beneficiaries, $2 million of that is taxed at 40%. And so the estate tax exemption is a massive problem for the people who are over the estate tax threshold. So that's the picture of what we're talking about.
Yeah, and now you have a $30 million for married couples, $30 million exemption, versus just 10 years ago, 9 years ago, it was 10, 11, right? And so that difference, like, there's a lot of people that have net worth estates that are in the 10 to 30 million range, right? And so if that were to change again, all of a sudden now that's an issue for a lot more people. And I think people have, we've seen it with planning and conversations where it's like, we don't have to worry. A lot of people don't have to worry about it. Under 30 million, that's most Americans. I think this is my concern here, and kind of what I wanted to talk about it was how much it increased in recent history, and how easy of a lever this would be to pull back down if certain people got elected or they were looking for levers to pull to try to raise some tax revenue. This would be an easy one that sure is going to make some people mad and impact a lot of people, but generally most Americans would not be impacted.
You would get a lot of Americans very for it if it ever became like a strong political topic of lowering it.
Yeah.
And I mean, also, I mean, the first chart we looking at, well, the government's not good at not spending money. So the other lever they pull, like you said, is increase revenue. And this is a real easy one that could always be looked at.
Mm-hmm.
Let me see if I can find this. I saw this talking about taxes. I got this quote the other day. I don't even know where I got it. I screenshot it on my phone. It says, paying taxes on money you make, paying taxes on the money you spend, and paying taxes on things you own that you already paid tax on with already taxed money. And like you think through that, it's like that is how our system actually works. And
I paid my personal property tax last week, and I've never been more angry in my life.
Yeah, it is crazy. Like if you read that,
It's a truck I've owned for 10 years. This is crazy.
You've lived a good life.
It's crazy.
Yeah, it's like we almost don't. I mean, there's like not such thing as personal property, right? So you don't pay the government. It's like, and so, anyways, this estate tax exemption, kind of a reminder of how much it did. Not that I'd completely forgotten, but I hadn't thought about it in a while, like how dramatic of an increase we got in 2017.
It's worth reminding yourself the 2017 tax code was set to come back in 2026 if the tax cuts were not extended. And so we would have been, if the tax cuts were not extended, we would probably be back to the estate tax exemption of that like $5-6 million per person.
Yeah.
And if your net worth is in that $12 to $20 million, right now you're not worried because it's $30 million.
Mm-hmm.
But if we would have gone back to this, we would have a lot of people who are impacted that wouldn't have been doing any form of planning preemptively to mitigate some of these estate taxes.
What do you think are some of the easier levers for the government to pull when they're trying to look at raising tax revenue? Like levers that would be, not that any of them would be popular.
Yeah,
but
I've always thought this.
So the estate tax
and corporate tax always pops up.
Yeah,
I feel like.
I think it's taking away deductions because you wouldn't have to say that we raised taxes, but you can take away credits, you can take away deductions, you can take away business deductions. Like you can take away a lot of stuff without having to publicize that you're going to be increasing taxes in any way because you're not increasing taxes. You're just taking away deductions.
You know, the one that I always think is going to pop up, and no one's talked about it yet, or maybe they haven't, I haven't heard it, is step up in basis.
I
think that one is one that would just like.
I think sooner than later there's going to be almost like an estate tax. Like if you pass away and your estate is worth more than X or something, like you don't get a step up in basis. There's going to be something with step up in basis that's going to change because there's too much money on the table. That
they're already talking about taxing unrealized gain.
Right. And so getting rid of the step up in basis makes way more sense than that, right? And I think it would just be easier to implement. And so, but it would be insanely impactful in a negative way.
Eliminating step up basis to if you own stocks and you pass away, in most cases your beneficiaries inherit it tax free at the value of you passing away. So all these people who have really highly appreciated stock, or like especially around us, farmland that is now in Bentonville and it's highly appreciated assets, those go to beneficiaries tax free. But that would be a huge tax bill if they inherited it without stepped up basis.
Yeah, for sure. So anyways, kind of another depressing conversation going back to the federal debt.
But we bring Eli on and everything just gets so sad.
Wow.
Yeah. But the reality is we owe a lot of money, and interest payments are a lot. And so they're going to have to, hopefully it's a combination of decreasing spending and increasing revenue, but they're probably going to have to do both in some way. And so some of these things we're talking about are just probably the more likely things that we'll see. Another thing too is, they can keep rates exactly where they're at and just adjust the breakpoints, right? The income levels in the tax code. And that's a very easy way to maybe not impact a ton of people, or, say like, hey, we're not increasing rates, and you just adjust the breakpoints, and that can be extremely impactful as well.
I always find it conflicting. I think the general public would vote for the lower end of the spectrum to have more benefits, the lower income, the lower net worth. But the people who are actually passing everything are all primarily high net worth or ultra high net worth. And so there's just a conflict of interest there.
Always.
Yeah. All right, last chart. Historically, drawdowns are the norm, not the exception.
What a positive chart to end on.
Yeah. This is just a good visual that's, with the shaded areas that just makes it look more dramatic compared to just the line chart. So this is showing 20% drawdowns and 5% drawdowns when the S&P was in it. And you can see the market has continuously moved higher and been resilient, even though you can see it is very common for the market to be in a 5 or 20% drawdown.
Mm-hmm.
So volatility is normal. I think now with everything going on, it's some charts like this are nice to pull out and just kind of remind yourself of that. It's like, okay, like we saw the market get volatile, saw some pullbacks here and there. That in and of itself would not be out of the norm.
Yeah.
Right?
Yeah.
So, and I know, I had a few clients last week shoot me an email. Market, sold off for like a day or two, and they like immediately, cause it's just like you're at or near all time highs, everything going on. And so the second you see a -1% day, you're like, oh, is this it? Like that's where your mind goes. So you pull up charts like this and just remind yourself like, okay, it probably isn't. Mm-hmm. This is very normal.
You always have to remember too that psychologically speaking, the drawdowns hurt you worse than the increases make you feel good. And so knowing that drawdowns happen, knowing that they're regular, and knowing that you will have a stronger reaction to them are all things that make you a better investor. Mm-hmm. And so knowing they come, knowing that it's going to hurt worse than you making what you've made the last 3 years, but that over a long period of time, the market has trended upwards. There's no guarantee of it, but over the long periods of time, it does trend or has trended upwards.
Isaac?
No, agreed. I think it's definitely kind of, I don't mean this bad because I know people don't like it, but it's nice that there are the conversations of, hey, this thing doesn't always just move up to the top right corner.
Yeah,
finally happening. I've had a lot more healthy conversations recently than I had like all of last year.
Yeah. I like when there's volatility, right? It's to a degree, just because it's like, okay, the market is acting rational, like it should react negatively to negative news.
Mm-hmm.
So anyways, all right. So Eli, you have this withdrawal rate Morningstar piece.
Yeah.
What did you pull out of this, and kind of what are your key takeaways?
Well, so there's a reason that I'm not on the podcast very often, and the reason is because I spend a lot of time reading these articles and creating scripts for the data brief that I host. And so the whole idea around the data brief is trying to give data-backed decisions for investors so that they can make better decisions for their retirement or soon-to-be retirement. And this study was one of the best studies that I have seen on how you could distribute more from your portfolio whenever you're retired. Because anyone that comes in, whenever they say, how much can I take out, they always in the back of their mind have the 4% rule because that is what Google will push to them.
It's the most commonly pushed and accepted.
Yeah. And 4% rule is basically just you take 4% of your portfolio in the first year, and then that's it. You adjust it for inflation up each year. So if it was $10,000 is 4% per month, and inflation is 3%, you go $10,300 the next year, and you just keep doing that for the rest of your life. Well, I love to find things that are data-backed that will show ways that you can increase that. And this article was just a great way of showing it. And basically their highest case scenario for a distribution was 5.7%, which is significantly higher than 4%. And so there's more to this article than is probably worth us discussing on the podcast. But basically the summary of it, obviously we're not talking about 30-year-olds when we're talking about 5.7%. They're talking about a 30-year retirement. And to take a 5.7% distribution, you have to be flexible within your spending. So there has to be some discretionary spending within your distribution plan.
Does it get into how much that needs to be?
Mm-hmm. Okay. Yeah, because it talks about standard deviation of spending, how much that you need to be able to reduce or increase. So I found this really interesting. And basically my takeaway and what I would love the listeners just to think through is you can take higher distribution rates if you're willing to reduce spending in poor years.
Right.
And if you're not willing to reduce spending in poor years, let's talk about a 4% distribution.
Yeah.
Because that one is consistent, and it's built to be consistent. But if you want to maximize what you can spend, then let's talk about having some discretionary spending, paying off debts so it's not forced, and then we can talk about having some bigger distribution rates.
Yeah. No, I love it. This is great because we see it so often how people they're fearful to use their investment portfolio, right? And their retirement savings. They don't want to run out of money. And so I feel like we're pretty consistently trying to communicate to clients like, hey, you should go use this, like spend it. And so having the data back up, like, hey, here's data that supports you can go use it and still probably be just fine. You know, especially if you have the flexibility to adjust in the poor years. So good stuff.
That's cool. Did you read this whole thing?
I read the first 30 pages is what the data brief is about.
That's pretty cool.
I'll do a video on the last 24 pages.
It's about Social Security.
Okay, all right. Well, that's all I've got today. Four, I thought, interesting charts, kind of all over the place with small caps, federal debt, estate tax exemptions, and then volatility in the markets, and then withdrawal rate strategy. What's reasonable from a withdrawal rate percentage. So we'll try to link that in the show notes as well to that Morningstar article, so you guys can go look for that. So, anything to leave on? Anything we want to?
Hey, thanks for having me on the podcast.
Yeah.
Glad you're on here.
I'm good. Excited we got a little rain last night. Excited for football, all the stuff. My normal comments. Football season, colder weather.
Yeah.
Go, rain came.
Yeah, it is. I love this time of year.
Yeah, it's getting there.
Well, we're not quite there yet, but here in about a month. I love this time of year. So,
I also love a podcast that has no one that went to Arkansas on it.
You what?
Oh, nice. That's true.
Yeah, that is true. Yeah, my university is awesome at football.
Yes, we probably have the best.
We're
one
really
here.
good.
Yeah, go Harding.
Yeah. Well, as always, we appreciate you guys watching and listening. Give us a like, subscribe, shoot us a comment, email questions. We'd love to see those. We hope you have a great week, and we will see you guys next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.